My name is Michael Guyad, publisher of the Lead Lag Report, as well as Ron Insana. I think this will be a really fun and interesting conversation because Ron's been around a long time, not just as somebody who's in the media, but also somebody who has skin in the game and has a lot to say about markets. So, Ron, before we get too deep into anything here, I want to do a little origin story as far as your background. Who how'd you get involved in markets? What have you been doing for the last several decades in your career, and what are you doing now?
I'll start with at the end, which is I'm still a contributor to CNBC. I do some advisory work with Schroders North America, which is a London-based investment firm. So I basically offer my assessment to them of the market on a weekly basis internally, and then also meet with advisors around the country to discuss the very same point of view. My journey over the last 38 years was entirely accidental. I was a film major in college in Southern California, couldn't find work. A friend of mine from high school got me a job at the Financial News Network, which was the forerunner prior to CNBC, a first business television network in the country. Ended up staying for 38 years, was full-time until 2006 as an anchor both at FNN and CNBC. And then went off, started a fund of funds business, sadly, in 2006, sold it in 2008. And have been doing what I just described a few minutes ago ever since. And so out on the road a lot, giving speeches about the state of the economy. I am producing my first feature film this year, which is about a business scandal from 1963. We could talk about that later, but that's how I got here. It's been a fascinating ride, really, in many ways. Exceeded my own expectations in terms of what it's delivered to me, learning how to play three-dimensional chess intellectually every day by trying to understand markets and the intersection of markets, economics, politics, real life on Main Street, and even geopolitics beyond that. So as an intellectual exercise, it's really been a fascinating experience. And, being involved from time to time as well on the buy side has also, I think, in many ways, sharpened my focus quite a bit.
It's funny you mentioned the film major background. So my father, when he was alive, always encouraged me to take acting lessons, and he was saying that from the standpoint of somebody who was managing money, had his own RA, had his own hedge fund, and his point was that a lot of this business, unfortunately, is exuding confidence and maybe putting on an act to try to get assets because that's what unfortunately people gravitate towards. I'm just curious, given your years doing the media, if you see what happens in the financial media world as a form of acting, because the truth is nobody knows what tomorrow brings, and we all have right now. Really, and I'm not saying that as a criticism by any means. I'm just saying that I do think there are similarities to being a pundit, being on TV, being an analyst, whatever it is, and acting to some degree.
Yeah, I mean, I don't portray anyone other than myself when I do this. There are presentational aspects to this, and being a good communicator, and understanding how to deliver whatever message you intend to deliver in a concise and accessible way is extremely important. And that's true, as you say, even when you're trying to raise assets. And part of it is sales, honestly, and part of it is also having the understanding of your own methodology and being able to, again, convey that in such a way that people find it easy to understand, accessible. And I've learned that in a couple different ways. Just as an aside, I'd been at CNBC for a while. In 1997, I was asked to go on the Today Show to explain some things that were taking place in the bond market with respect to Fed policy. And Jeff Zucker, who was the executive producer at the time of the Today Show, and who went on to run NBC and moved to CNN later on, came up to me about 30 seconds before I went on the air, and he said, well, "Whatever you do, don't do that shit you do on cable," which meant don't speak in jargon. I have a lay audience. Make it easy, make it understandable, make it accessible, and wear a different hat than you wear on CNBC. So yeah, in the sense that on the one hand, I could be more technical and maybe speak at a slightly different level on CNBC than I might on the Today Show. You have to learn how to address different audiences in different ways to make sure that you capture their attention and get your point across.
Well, right, and part of capturing that attention is to be entertaining.
Oh, right? Absolutely.
Right. Yeah. And I understand, like, that's always, it's like a lot of people have said to me when it comes to traditional media, and I don't disagree that, keep in mind they're entertainers first before maybe focusing more on the analytics. And to some extent, that's not an unfair criticism, because you're going to lose the audience if you simply talk numbers and very dry matter of fact.
Yeah, I would say. I mean, I would say with respect to journalism, and again, this is very much different since I started the business. We were dry in the early days, and we were encouraged to be so. There was a period, until the last 15 years or so, where our job really was to not say what we thought, but to say what we knew. Which, and by that I mean, what information have we obtained? Then we share it after having confirmed it. And really the presentation of it in the earlier portion of my career was very, very different than the presentational approach today, which was that, yes, there were organic moments where things were maybe a little bit more entertaining. Then there were also very, very serious moments in which you kind of contained yourself. But it's still in a certain sense, given kind of the way I came up in the business, I I view it less as entertainment, but more like being a very good, engaging professor or teacher, and certainly an overpaid one at that. So it's in my mind, it's slightly different, I think, than the way you would characterize it, but effectively, the result is the same.
Right. And yeah, I'm always big on incentives when it comes to trying to determine why somebody frames things the way they frame them. I'm very open, right? It's like in my case, my incentive, my bias is always not that I want to see markets go up or down, but I want to see them go up and down, right? Because that's what risk
Yeah,
on, risk off is really about. I want to see
yeah.
some volatility for these periodic periods. I'm very open about that. It's like that's my bias. I'm aware of the bias. Doesn't mean that I'm going to be right or wrong. It's just I lean toward that view of the world. But from an incentive perspective, I remember vividly, and it was not CNBC. I'm not going to say which organization it was when I was doing the media rounds. I was doing a show as a co-host, and during the commercial break, I'd asked the anchor, how are ratings? And the anchor said to me off air, ratings correlate to the VIX. And I smiled, right? I said, so does that mean you have a hidden incentive to create a degree of fear or nervousness, right? Oh, we're back here with Michael Guide. So I only say that because, I do believe it's good for people to be skeptical of the medium to some extent, but also recognize that the medium is catering to the audience, not the other way around.
Well, yeah, always. I mean, and now with respect to that correlation, we did a study a long time ago, and volume was also equally important to volatility as a consequence of engagement. So, but I never. I mean, the only reason I looked at ratings was to see whether or not the show was doing what we hoped it would do, and we, since we didn't have any incentives attached to the numbers themselves, although at one juncture, we had a boss that tried to tie our compensation to ratings. And this was at a period in CNBC's history where the margin for error in the Nielsen ratings was probably larger than the rating itself.
Yeah, yeah.
And the late Mark Haynes refused. He was the first contract up, and he refused to go down that road. And the rest of us would have as well, because we had literally had no control over the ratings. And when you're in a niche service, as CNBC was for so many years, um, you don't want to be tied to that. You don't want to be tethered to a number that no matter what you did on any given day, you probably couldn't drive a number. And when we had our peak, in my career anyway, our peak numbers occurred from 1997 to 2001, and my show at 3 o'clock was doing 8 or 900,000 homes a day, which was unheard of in cable at the time, particularly for a news network. Now, I was making perfectly good fine money. I was more than content with what I was doing, and the opportunity set that existed beyond that as well. We didn't trade. We weren't allowed to trade. So again, our incentives for driving certain activities were somewhat more limited, and that's still true at CNBC today. You can't trade uh, individual stocks. So um, we looked at ratings as a measure of success in a certain respect, and the better the organization did, obviously, the more we'd get compensated. But in my experience, like I never ginned up stuff. And in fact, quite frankly, with markets, you don't have to. I never ginned up activity to try to get an audience that was bigger than the one I already had.
I'm glad you mentioned that point about having no control over ratings, because the other thing you don't really have control of in this business is your actual performance, your actual outcome, which I think it makes this domain of investing really quite unique. I've always made this point that I don't think there's any domain outside of investing where it is so ambiguous in terms of how much of the result is because of randomness, luck, skill, effort.
Mhm.
Whereas you can draw a clear line between your knowledge and how good of a surgeon you might be, right? Or any other
Yeah.
kind of industry, right? So there's a degree of sort of a chaos element in markets that makes it very hard to know if all of your effort and outcome is going to translate into the right outcome. Now, you talk to a lot of advisors, and you talk to a lot of different people. Um, what do you find is the thing that gets people most tripped up? Get people most tripped up on when they think about performance and the environment they're in? Because I feel it. I know I can't control it, but it feels awful, right? But I have to
Yeah.
keep on going through that hell. That's not so easy for a lot of people. So talk about some of the things you've seen over the years in terms of when people who are really hard workers are just going through a nasty cycle, and how they're able to kind of push through that.
Well, some can and some can't, and sometimes sometimes the market is more dominant for a longer period of time than their discipline can withstand. And so, I've seen that on numerous occasions. The bigger risk that I've always seen, and that's really, gotten people into trouble, is abandoning the discipline that they develop, and all of a sudden beginning to rationalize certain changes to their models, or doing things that are contrary to what got them to where they were in the first place. And again, there's a corollary to that is, the markets can remain irrational longer than you can remain solvent. And so it's a double-edged sword. On the one hand, you have a discipline, you have a model, you have an approach that has worked for a particular period of time, and then there's this moment in the market like we're having right now, where everything gets blown up. And so the model doesn't matter, the approach doesn't matter, the discipline doesn't matter. You're just being dragged out to sea by a very strong undertow that really doesn't care how disciplined you are. So there are, it's a kind of a two-sided problem. Sticking with the discipline during periods like this can be really, really hard, really challenging, can take a lot of people out. Abandoning one's discipline to rationalize an approach is the flip side of that, which I've also seen take people away. And the other expression that we often use in our world is, never complain, never confuse brains with a bull market. Bull markets cover a multitude of sins, and when you've gone up 500% since 2009, when you doubled in 18 months out of the pandemic, a lot of people made a lot of money. And now some of their prognostications are falling quite flat, given that we're in a fairly vicious bear market for the amount of time that we've been in it.
Okay, so that's a good direction to go. The amount of time that we've been in it, because no one seemed to have a sort of consistent starting point for when this bear market started, because the underlying dynamics have been so weird for so long, right? I've
Yeah.
argued many times that the bear market really started February of 2021, because that's when most things peaked. It's when the speculative fervor and ARK peaked. It's when Bitcoin did the initial peak before the final blow off, in the, I believe, third quarter. How do you think about time when it comes to environments like this? Because I always make the point myself that every storm is a function of not just the intensity of the storm, but how long it lasts.
Oh, absolutely. I mean, there's no doubt, and I've been saying this actually for many months, that in this particular instance, time is as important as price. And so when you're only, at least we think, we're either in the third, fourth, fifth inning of the Fed's tightening cycle. That means that we're going to have a longer period of struggle. Now, that's having said that, if something breaks and the Fed stops, we're going to rip to the upside. And I think everybody needs to be alert to that fact, that particularly when you're looking at markets today, and it is literally risk off across the board. There's nothing that's not getting hit today. There's a point at which, if the Fed goes too far and they break something, the cycle starts all over. They stop raising rates at some juncture. That's possible they'll be forced to lower them again. And so, in that regard, that would mess up the time schedule that we're currently on, which assumes the Federal Reserve is going to continue raising interest rates through the end of this year, three-quarters of a point in July, maybe a couple of 50s, some 25s early next year. And typically, markets don't bottom until investors, and particularly very sophisticated investors, become fairly certain that the Fed's about to stop or about to go the other way. And so that's the variable here that I think is most important is what breaks, when does it break, when does the Fed stop? And then you could kind of say, okay, we're through the worst of it.
So you know what's interesting to me about that is because you hear that line a lot, right? The market's going to keep doing this until something breaks. The Fed's going to keep raising rates until something breaks. But I would argue that the market is breaking the Fed here, right? Because the speed with which bonds have sold off, the speed with which yields have risen, is way faster than what we know the Fed has done with the short end, let alone this beginning of QT. So I always make it a point. It's like what's leading what, right? So Bespoke had this great stat showing that if you look at the total market cap loss of stocks and bonds, you're around $14 trillion that have evaporated.
Right.
That's 1.5 times the Fed's balance sheet. Now I get it, it's different because it's dollars in circulation versus marginal price, which is market cap, but still, there's been a hell of a lot of devastation. So who's really leading whom here? Is it the Fed leading the market or the other way around?
Well, look, the market's always led, and at least in my experience, I've never seen a period in which the Fed has led. The perceptions about what the Fed will do based on expectations, or in this case, forward guidance, which has become a much more important component of Fed policy, sets the stage for the markets to lead. And even when the Fed was extremely opaque, when I got in the business in 1984, and William Greider of Rolling Stone magazine had written The Secrets of the Temple about the Volcker Fed and how just absolutely opaque and impenetrable that institution was at the time. Today we have almost complete transparency, and the markets still behave in many ways in the same way. I would argue that the reaction function is much quicker, that markets respond a little more quickly than they used to, and the real effect on the economy happens more quickly than it used to. And this notion that monetary policy operates with a considerable lag is extremely archaic. But generally speaking, markets always lead, and they will turn or force the turn, as you suggest, at some juncture in the future. And so when that thing breaks, whether it's tether collapsing, whether it becomes untenable for Europe and Japan to kind of deal with some of the currency fluctuations that they're seeing, or something else transpires. 94 it was Mexico and Orange County, 97 it was the Asian currency crisis, 98 it was Russia and long-term capital. The depth of the recession after the tech bubble burst, then 9/11, corporate scandals. Eventually, the Fed had to reverse, but that was a really long process. That was 2.5 years. My guess is this is like a 12 to 18-month issue if the Fed continues on this current course, and we'll get a recession of some kind, and then at some juncture, they'll have to stop doing what they're doing.
So I'd asked Julian Brigden this question, and I think it's appropriate given what you just said about the forward guidance. You and I both know that it used to be the case that the media would focus on the width of Greenspan's suitcase, right?
Briefcase. Yeah.
Right, the briefcase, right? In terms of to get a sense of what he was thinking and what the Fed was going to do next, where you didn't have the transparency, right? Greenspan was the antithesis of transparency from a communication standpoint. I wonder, given your years of experience, if you think the Fed maybe did itself a disservice by being too transparent, because my argument would be that they create a false sense of confidence that they can control the unknowable.
No, I don't think so. Like the briefcase indicator, which I think was Mark Haynes, the late Mark Haynes, came up with that. And I think to a certain extent, at one juncture, that kind of started off tongue in cheek and took on a life of its own. I don't think that, and I don't, and I've spent a lot of time with Alan Greenspan. I don't know that there was any correlation between the size of his briefcase and what the Fed intended to do. He didn't take any more paperwork with him on the way to the office on any given day than any other. But no, I don't think the Fed's done a disservice with more transparency, because if you go back to the beginning of my career, and I started in 1984, we didn't know what the Fed did even when it did it. So this whole cottage industry of Fed watchers that began to interpret the daily injections of liquidity into the banking system, or the withdrawals of liquidity from the banking system, whether they were temporary or permanent, whether the money supply was growing on a Thursday afternoon when it was reported, or whether it was contracting a little bit. We would not know what the Federal Reserve did until we got a confirmatory statement from the Fed after the fact. gradually over a nearly 40-year, almost a 40-year period now, the Fed isn't just telegraphing anymore. It's actually doing what we like, having gone to film school, what we were taught to do in a comedy movie, which is you with the sight gag, you tell them what you're going to do, you do it, and then you tell them what you've done. And that's where we are with the Fed. And I don't think that they're any worse for wear. Is it more apparent maybe that they're not as infallible as we might have thought in prior periods? Yeah, that's probably true. But I don't think we're worse off because they're more transparent. I mean, listen, people have been second guessing the Fed since before the Volcker days, and in some cases, rightly so. But I think it's an institution that does the best that it can with the information at hand.
Now, to that point, about the cottage industry of Fed watchers and not knowing what the Fed was doing until, maybe long after the fact. I have to assume not everybody really knows all the intricacies of the Fed even today, despite all of the coverage and all of the discussion, because the number of things that the Federal Reserve does is far more in terms of market intervention than it used to be decades ago.
Well, yeah. I mean, it depends which markets you're talking about. I mean, certainly in the aftermath or at the depths of the great financial crisis and subsequent recession, or during this period when the pandemic hit, the Fed has opened its toolbox well beyond the number of tools it used to deploy to presumably fine tune the economy or make adjustments as necessary. I mean, the very blunt instrument of interest rates and manipulating short-term interest rates has principally been what the Fed has used up until these last two experiences, in which case then they've added not only quantitative easing, which occurred during the great financial crisis, but then more recently getting into a wide variety of areas that the Fed's never touched before. And to a certain extent, that toolbox is relatively unlimited. And these are based on off the record conversations I had with Alan Greenspan at different points along the way. And he said, listen, from a statutory perspective, if the economy were in a deep depression and we had to do something beyond moving interest rates, he goes, we could buy furniture and store it just to increase demand levels and then also force manufacturers to produce more goods and restart the economy. At least theoretically, the Fed could go well beyond the scope of behaviors that we'd seen in prior periods. And yeah, beyond that, there's regulatory issues, there's bank supervisory issues. Um, More recently, some social issues around business activity have crept into the Fed's so-called dual mandate. So yeah, they have a lot on their plate. It's not just pulling the lever on Fed funds whenever they get together.
Yeah, so we go from furniture Greenspan to helicopter Ben. As it sounds like.
Yeah. And look, I think that's really kind of an unfair assessment that people made of Ben Bernanke, which the whole helicopter money thing. When you have a systemic financial crisis, which if you read his book or if you would have listened to Mervyn King, who was the head of the Bank of England during the global financial crisis, we were anywhere from 3 hours to 48 hours towards global systemic financial collapse. And Ben Bernanke, who studied the Great Depression in exhausting detail, really focused on what the shortcomings of policy were during that period and understood that if you're facing a crisis like that, doing too little is a much bigger risk than doing too much. And that's what drove some of his statements about flooding the system with liquidity, which is something that Greenspan had done before him during the crash of '87 and so on and so forth. So yeah, I mean, Ben is an extremely thoughtful individual, and I think maybe in our lifetime the best Fed chair we've ever seen.
Okay, so now what's interesting about that is, and I even tweeted that last night after having a drink. I said liar, and I put up the 60 Minutes interview with Bernanke. And this is not, I'm not trying to make an argument about whether he's good or bad, but it's interesting when you kind of look back. So one of the things that Bernanke had said in that 60 Minutes interview back in early '09 was he was asked the question, are you worried about inflation? And he said that no, we can raise interest rates in 15 minutes if we have to.
Correct.
And right, and which makes sense. Again, it's like you're stuck by the zero bound. That's why we had to do QE to begin with. So if you want to liquefy, you've got to be creative. But it's true, if you really want to take liquidity out, then you can do so very quickly by just raising rates. Now, the question is, why hasn't the Fed here been more aggressive, right? Because to your point, their job is to liquefy. It's the whole reason the Federal Reserve came into existence after the banking crisis of, I think, 1907.
Yep.
The whole idea was flood the system with dollars when there's a tail event so you don't have these constant rolling depressions, right? And the
Correct.
Fed has done a good job overall. You can argue with that, although it's created, I would argue, other dislocations in the system longer term, which we can talk about. But why is it, from your vantage point and from your experience in talking to a lot of these guys, why is the Fed not being even more aggressive? You can argue they're aggressive, but I don't think the market really views it that way.
Well, I would argue the exact opposite. I think that the market's getting quite fearful that they're going to be too aggressive, and I happen to think they've already been too aggressive, in the sense that I still believe, and there's some validation of this notion coming out of the San Francisco Federal Reserve, that the majority of our inflation problem is a supply side and supply chain disruption after effect. It's much more like the after effects of a war than it is the typical end of a business cycle where you have demand pull inflation. The San Francisco Fed put out a study the other day that said 2.4 percentage points of inflation is coming from the supply side disruptions, and about 1.5% is coming from excess demand. And so, again, the supply issue is much greater. It has a much greater impact on current inflation than the demand side. And so that would argue, in my mind, for the Fed to be very, very gradualist, not minimalist, but gradualist, deliberative, and very clear about its policy initiatives, rather than being aggressive and throwing us into an unnecessary recession. I mean, Larry Summers came out the other day, the former Treasury Secretary, and suggested that in order to bring down inflation, we would probably need to see the unemployment rate go from the current 3.6 to 5% and stay there for 5 years, which I think is just utter bullshit. I think that's nonsense. Throwing people out of work is not a solution to a supply side inflation problem, particularly since China is not fully back online. The war in Ukraine, which is disrupting food and energy supplies, rages on. I would have preferred that the Fed move in 25 or 50 basis point increments and not engage in QT, not engage in quantitative tightening, until it was certain that there was something else going on. And if you look at the pandemic too, there have been massive disruptions just beyond the production of raw materials and finished goods. We have a labor shortage in the United States that is profound. The population of the United States grew at its slowest pace in the history of the country last year. There's nearly 1.8 jobs available for every unemployed worker in the US. So wage inflation is not a function necessarily of an overheating economy in the way we're taught in Economics 101. It is also a function of the fact that we've lost people during the pandemic. There's been a profound change in psychology among workers at all levels, and that's given them more power than they've had at any times, in the recent past. So I really think that a much more deliberative course of action and a lot less noise from individual Federal Reserve governors would be a better path, and would assist the market in understanding where we're going, rather than this, like, we're going to kill inflation at all costs, even if it causes a recession. I think that's the mistake that's taking place right now.
Yeah, I don't disagree, but I'm curious, and I don't know the plumbing well myself, but I remember I did a space with Joseph Wang, Fed Guy 12 is his Twitter handle, and he made that he worked at the Fed and did trading within the Fed, and he made this point that the Fed does have the ability to direct resources to certain industries that might be politically in favor. And he was really kind of alluding to more ESG and use that as kind of an argument for why there's been perhaps so much underinvestment in the energy space. Um, is there validity to the idea that the Fed can maybe longer term do something, or at least create the conditions to allow for more redundancies when it comes to supply chain, maybe by somehow encouraging more competition, or maybe directing liquidity to areas where you need to have some of these
Well,
supply
I,
crunches
I'm
available?
not, I'm not quite sure. Listen, and if he worked at the Fed, he has obviously seen things that I have not seen, because I'm a journalist, not an employee. But I mean, from my understanding of how the Federal Reserve operates, it is a very broad construct that is not targeted. And so, if the Fed lowers interest rates and increases the money supply, they don't direct that money supply to a certain industry. The money supply goes up in aggregate, which is why we call it monetary aggregates. And so until recently, the money supply grew. It was growing 20% year over year, and now it's beginning to contract. And so one would have to argue then that they're withdrawing liquidity from those very same sectors that they're trying to help, irrespective of what their desired outcome would be. So that I think is counterintuitive, and in fact would argue against having a point of view that the Fed has the tools to engage in industrial policy. That's much more um, in the purview of the federal government or states and other entities that can drive those outcomes with different policy sets. I don't think the Fed has the ability to direct liquidity, if you will, to kind of like most favored nation type industries that would benefit from their infusion of cash, unless they're doing something backdoor that I don't know about, and subsidizing specific industries. But that's really more how the tax code works. It's more how the regulatory and legislative regime works than how Fed policy functions.
So, somebody who I track, who I've interviewed and who has interviewed me, Andreas Steno Larson, he put out a tweet where, very, very intelligently, he basically said, "Let me go to Google search trends and see how many people are looking up the word recession." And the number of on the search index on Google Trends, the number of people looking up the word recession is higher than it was in 2020, higher than it was in 08.
Yeah.
Now I see that, and my contrarian antennas come up. All right, it makes me think that the last time you saw these kind of peaks were around the baby formula shortage, right? In terms of just search trends and
Yeah.
people being nervous about that. And then, you can see that historically, whenever you have even NFTs, when you look at the Google search trends, they peaked. And then the moment they peaked is when, the interest completely died down and all these things started collapsing in price. How do you interpret the current environment and the current sentiment? Because I don't recall a time ever, and maybe this is just a function of my own length of my career, where people were so certain of what's to come.
Oh, listen. It depends. Look, first of all, I mean, like kind of where you stand depends upon where you sit. So I can tell you, in 2007 and in 2008, there was certainly far more fear than I've ever seen before. There was great confidence, great ebullience, great you know belief that trees would grow to the sky in 2008 with respect to the housing market, with respect to the boom in the economy, until it stopped. And then, if you'll recall, when people were worried about the viability of our financial system and the banking system itself, I was among those people taking out money from the banks in advance of a prospective bank holiday, should we have something beyond the Lehman moment that we had. So, look, I think, there are a lot of periods in history where people were scared and reasonably certain that they were in a bad environment. I grew up in the 60s and 70s. And so, I remember that period. In many ways, it was worse than this one. We have an inflation problem. We don't have a growth problem. We don't have an unemployment problem. We don't really have a wage problem, except to the extent that wages are not, real wages are contracting a bit. And yes, I think people are looking at a recession because the stock market's down a lot, and it's down every day. It's been down now, 11 out of the last 12 weeks. It's been down all year. We're down 20% on the S&P, down 30% on the NASDAQ. We're down 80% on the meme stocks that the public got deeply involved with, and to a certain extent, emotionally involved with, if you will. And so I think they're right to worry about a recession. However, I am not among those who think that recessions are psychological events. I don't think that they're self-fulfilling prophecies. I think they're the result of policy that, in this case, and at least at the moment, I believe that recession may well be a feature rather than a bug of Fed policy to beat back inflation. I think it's a mistaken point of view, but I think that's what's happening. And I think people are right to be worried about it 6 months from now, that we could see the unemployment rate, obviously going back up from what is right now a near historic low. Well, look, I mean, the credibility thing is a funny thing. On the one hand, I think that's a creature of conversation among academics and other market observers who are desperately trying to find, something. And I'm not a Fed apologist by any stretch of the imagination. I should put that out there. But I mean, when they talk about the credibility of the Fed, for years it was inflation fighting, and then later in our life it was deflation fighting, and now at least for a period of time we're back to inflation fighting. And I think they're doing, in my mind, a little more than they should, but they're doing the best they can under the circumstances in which they're operating. And again, if we go back, and I haven't said this yet, but I mean it's again because I keep saying it in a lot of other venues. If you go back to February of 2020, pre-pandemic, the unemployment rate was at 3.5%. Inflation was still below 2%. The Fed was contemplating raising rates to just slow the trajectory of the economy a little bit, even though it wasn't necessarily satisfied that inflation was hitting their 2% target. This was like driving down, a country road where you don't see anything for miles, and then suddenly a deer runs in front of your truck. It's out of nowhere we get the pandemic, and it's bigger and worse than we'd anticipate, that we didn't anticipate. I mean, we and it went deeper, and it lasted longer, and then beyond that, China shuts down its economy with a zero COVID policy. Russia invades Ukraine. When I hear people talking about the credibility of the Fed, they've been hit with the types of things they're not necessarily built for. I mean, they're not built to counteract the impact of a pandemic on the economy. That's not, they don't have tools in their toolbox for what we saw, which was a complete shutdown of our economy, a shutdown of the global economy. You go back to April of 2020, air passenger traffic fell 97%. Cost of an airline ticket was zero. Right. And then we flooded the system, both from a fiscal and monetary policy perspective, with money. Demand came back quicker than supply. Again, very much like a post-war environment. And we've had these disruptions in every conceivable way. So I don't view their credibility at risk, because I think they're being hit with a set of problems that aren't theirs. And the only tool that we have at the moment to fight inflation is higher interest rates. And I still view that as the wrong policy tool. So, it's really, in the main, it's a much longer term question about supply chain resilience, or as H.R. McMaster had said on CNBC some months ago, during the process of globalization, we traded supply chain security for supply chain efficiency. And so I really think there are more governmental policies, not from the Fed, that would ensure that resiliency by creating the types of incentives where we have redundancy in our manufacturing industries here, and a host of other policies that would encourage working with friendlier countries in that regard to ensure supply chain security. And so I think the Fed's just been doing the only things it can do in an environment where prices have spiked and nobody else can do anything about it.
That adds to the point I myself have said many times, is that the ultimate solution to supply chain disruptions is more competition, right?
Which is more stuff,
right? Just more stuff, right? What competition would bring, right? I mean, that's kind of the link there.
Well, I mean, it's very much, I shouldn't say it's very much, but to a certain extent, it's a closed system that's a little bit less reliant on the rest of the world than we are. They still, because of everything that happened from 1989 forward, when their markets peaked on the last day of that year, and then went into a nosedive, they also have enormous demographic problems, large savings pool, very different, but a much bigger debt to GDP ratio than we have. They just have a lot of the characteristics of the Japanese economy are radically different from those of the rest of the world, and have been, kind of asynchronous since their markets peaked in '89, right? I mean, there's been a lot of things happening where they have not been able to reinflate their economy in a meaningful way. They've been in and out of recession about 50% of the time since 1990. Just an entirely different set of dynamics, and certainly behaviorally, the Japanese culture is far different, and so they're willing to sit with different things than we are. And I just think that at the end of the day, given the massive demographic issues that they have, where they're aging even faster than the rest of the world, and they don't, in fact, encourage immigration, even though they've tried recently, they're they're kind of like a liquidating trust in a certain sense. They're going into near irreversible population decline, and so it's almost an apples and oranges comparison when you look at the Japanese economy and everyone else. I mean, China may face some of the same problems down the road. They're just not having them yet, but their growth has slowed as well. Our population growth has slowed too much, but we can fix that by opening the borders, which even in this political environment, at some juncture is going to happen because we've done it in the past. There are other countries like Japan that just don't do it that often, if ever. And so I think they're kind of bound to a degree of stability that comes from the type of insularity that they have, but also a lack of dynamism to a certain extent because of the insularity that they have. Sometimes yes, sometimes no. I mean, I would argue that under the circumstances today, or let's say over the last 2 years, I don't think I don't think that any reasonable person could say we knew what the outcomes of these kind of multifaceted events would be. And so it's easy to say that everybody overdid it. You know, that Trump spent $2 trillion, Biden spent $1.9 trillion. The Fed increased the size of its balance sheet dramatically, kept rates at zero, engaged in a series of interventions in non-traditional markets outside treasuries or mortgage-backed securities, and then got into the direct lending programs and things like that. It's easy to say they did too much. And remember, in the middle of 2021, we thought we were entering the endemic phase of the pandemic and that things were going to be fine. And this was even after Delta. And then what happens? China closes down with another wave and literally shuts down its entire economy. Thousands of ships are stranded at port in Chinese waters. The supply chain disruptions actually get worse. Russia goes into Ukraine. And so there are no dot plots, just to kind of go back to what the previous questioner was asking. There are no dot plots that you can have for that, right? I mean, there's no forecast that can consume that many variables and then spit out an answer that's appropriate. And let me tell you something. Had the federal government and the Federal Reserve not done enough during that period, and I'll be blunt here, the shit would have hit the fan, right? We had 22 million people out of work, an unemployment rate of 14%. We had actual deflation. We had people not leaving their homes for months on end, schools being disrupted, businesses shutting down, going out of business, all of those things that were happening at the fastest pace we'd ever seen. And then people go, well, everybody did too much. Imagine had they done too little. It would have been an entirely different set of conversations. And so we'd be deflating now dramatically, kind of like 1930s style. So, yeah, you can criticize the Fed for having done too much and waited too long and all that kind of stuff. But again, we're still not even out of the woods when it comes to some of these other issues like the war in Ukraine and any other prospective geopolitical risks like China going after Taiwan. So the only reason I'm hesitating to criticize policymakers here was that all the outcomes were unknown. And so I don't think, given the way in which large institutions move, that you could say they did too much too fast when most of the time they do too little far too slowly.
And I will say real quick, I mean, it's all this is easy to say with hindsight, in fairness, right? They can't predict the future better than anybody else. You can argue they can somewhat create it, right? But
Sure.
In fairness to the Fed.
Look, I mean, it's in a lot of ways it's changed with terrestrial cable. Just to point out all the other competitors that we have in the space, both on the general news side and the business news side. Obviously, it's become more personality driven. It's not kind of the dry recitation of numbers that we did when I first started, and with the advent of social media as well. And we saw this obviously with the meme stocks and the Reddit and Wall Street Bets crowd and all that. There are additional challenges in dealing with market disturbances, if you will. We've always had them. I mean, it used to be the rumor mill, right? I mean, somebody'd start a rumor in London that would get to New York, that would get to Chicago, that would wag the market. And it was a slower process, but we still had to jump all over it and confirm or refute whatever was being said. It's harder now because of the multiplicity of sources. It's harder to be out in front of stories in a lot of ways because stuff travels so fast over so many different transmission wires that it's a bigger challenge. I think if you're a working full-time journalist to chase things down. By the same token, the best people doing the best work are still doing, in some ways, exactly what they did in the past. Guys like David Faber and Steve Leisman and Meg Terrell, and Leslie Picker and others, and many more people. I'm leaving some out, obviously, at CNBC and elsewhere. They're still getting their sources together. They're still doing the kind of, really walking the streets type of work that you have to do in journalism to get the story. At the end of the day, a portion of our business, obviously, raw data, has been commoditized by every technological device that exists. Also, at the end of the day, markets behave exactly the same as they used to. It's just a lot faster, and you get the same stupid stuff going on in every cycle. I mean, you could go back to the 20s. We don't have the time to discuss that, but there's the same kind of crazy up and down today that there was 100 or even 200 years ago in markets that'll simply never go away. And it's just our job to stay on top of those trends, those moments of speculative excess, and the responses that occur to them. Well, it's a solution to the security question, not the efficiency question. So you want redundancies there that can make up for lost product if we have another event like the one we had. The flip side, too, is if you look at capital expenditures, productivity enhancing software and hardware is also being purchased at a rather rapid clip. And so as more and more companies automate, there'll be a disinflationary trend coming from companies using either software or hardware, and by that I mean robotics and other types of mechanical, if you will, devices, to eliminate the need for high cost, or even in some instances low cost or rising cost workers. Like you look at restaurants right now. I was talking to a manager in my neighborhood, $17, $18 an hour for a busboy. They see 50 cents more at Burger King, believe it or not, and they go over there instead of bussing tables at a high-end Italian restaurant. So those jobs can't be automated, but when you look at the quick service restaurant business, for instance, a ton of stuff is going to get automated, and we're going to see more and more of that. And I think the onshoring is more for redundancy and security than it is necessarily for efficiency. And so they're going to have to find a balance there so that it doesn't become, as you said, a higher cost solution to what we currently have.
All right, for the remaining minute or so here, Ron, and again, everybody, please make sure you follow Ron Insana here on Twitter. Tell us about this feature film.
So I was very much taken by Art Cashin. Told me the story years and years ago about something called The Great Salad Oil Swindle, which was a book published in 1965 by a Wall Street Journal reporter who won a Pulitzer for covering this event that occurred in the days leading up to JFK getting shot. A gentleman by the name of Tino DeAngelis tried to corner the world market in soy oil futures, and he'd been in the gray area of the commodity business his whole life. He did this by leasing out empty petroleum tankers in Bayonne, New Jersey, filling them with salt water, floating oil on the top, and then using that phony collateral to borrow hundreds of millions of dollars to effect his corner. It failed in the third week of November 1963, crashed the stock market, and was the biggest scandal on Wall Street since the 1920s. And JFK, sadly, was assassinated on that Friday. The 4 days leading up to it, Wall Street was much more preoccupied with the effects of the salad oil swindle, which almost took down two very prominent Wall Street brokerage houses and dinged American Express for $90 million. They had a field warehouse receipt company that vouched for his collateral, which was effectively either salt water or gasoline in these tanks with oil floating on the top, just so the people thought he had the goods. And it was a very big deal. It's a great, colorful story. Tino DeAngelis is a character with virtually no redeeming characteristics whatsoever, but it's a great story. It's undertold, and we think that it's going to make a great film. And so hopefully September, October is when we begin shooting, and sometime next year it will either be streaming or in a movie theater near you.
We'll definitely have you back when that's out. So everybody
Please
here,
do, yeah.
yeah, exactly. You always got to be promoting. It's not an ABC always be closing. It's always be promoting ABP. So everybody that's here, thank you again for joining. I will have this as an edited YouTube video. Ron, I know you and I are going to be interacting hopefully more in the future.
I think so. Yes.
Certainly appreciate the hour here, and everybody enjoy the rest of your day. Thank you, Ron.
Thanks, everybody.